Hey, good morning, everybody, and welcome to Coffee with Great Wealth Strategies. I've got my cup of Joe, and we're ready to go. We're going to talk a little bit about the fiscal cliff that's looming out there today, and analyze that a bit. In our last piece in our blog, we talked about how quickly the approaching economic catastrophe known as the fiscal cliff is coming. And today we're going to look at the potential outcomes that may result from the political horse trading that will most likely take place between the Republican and Democratic parties following, and this is following, the November 6th election, and what it will mean for the average individual investor. If you remember from the most recent blog, the combined spending cuts and tax increases amount to $600 billion to $700 billion that are going to hit the economy. Many in the financial and political realms predict this will have between a 3 and 5% off GDP, off the annual GDP. That's going to reduce the GDP by 3 to 5%. Though the final number is hard to predict at this point, it represents a worst case scenario, and thus it's most unlikely, but that would be pretty daggone bad. So assuming that the national politicians can cut some sort of deal, which I think they probably will, it's safe to assume that some of the economic sweeteners deployed during the depths of the financial crisis will be eased or axed. Many economists agree that the 2% payroll tax cut enacted in 2010 will be on the chopping block, gone. This could hit the consumer economy in a big way, not a big way, but a huge way, and may cause unforeseen turmoil in retail stock markets. Similarly, unemployment benefits that were extended as part of the Budget Control Act of 2011, which mandated the sequestration cuts, may be rolled back as well. For higher income investors, the Obama administration's efforts to raise taxes will likely make the situation far more worse. There could be higher tax rates for those who make more than $250,000 per year. Those are small business owners, and those are folks that employ people. Most likely a jump from 35% to 39.5% annually will take place. Additionally, capital gains taxes, which range from 15 to 20% currently, right now in 2012, that depends on a person's income bracket, could be raised to as much as 30%. So that would be from 15 to 20, be doubling the capital gains tax. What will the result of these actions be? Economic growth will certainly take a hit, no matter which way we go. It's going to take a hit. According to a recent report from Credit Suisse, an international bank based out of France, the best case scenario involves a transitory 1% detraction of the GDP. Though it is likely to be higher, regardless, investors need to take charge, protect their money. They can do this by contacting Great Wealth Strategies and asking about our tried and true wealth preservation methods. So give us a call, shoot us an email, visit us at greatwealthstrategies.com. And this is another edition of Coffee with Great Wealth Strategies. Thanks for joining us.